The United States is less than 5 months away from tightening restrictions on Chinese rare earth magnets across the entire supply chain. But US industry is nowhere near ready to meet that requirement. And now, some investors are betting that Washington will struggle to overcome China's dominance of the global rare earth market. Washington has already poured billions of dollars into critical mineral mines, processing plants, and magnet producers. But US output remains far below consumption levels. Last year, the Pentagon entered into a public-private partnership with US rare earth producer NdPr Material. That partnership focuses on the rare earth elements NdPr, which is short for neodymium and praseodymium. These are used to make the powerful magnets found in fighter jets, missiles, electric vehicles, industrial machinery, and wind turbines. The agreement guarantees NdPr a price floor of $110 per kilogram. If qualifying NdPr output is valued below that floor, the Department of Defense pays NdPr the difference. But part of that price calculation still relies on Asian Metal's Chinese price assessment. When that assessment falls, the Pentagon support payment to NdPr rises. So even this attempt to build an independent US supply chain remains financially tied to price movements inside China. Washington is unable to switch to a credible non-Chinese price index simply because none currently exist. So for now, China's physical market will continue to dictate the size of Washington's support strategy. In fact, hedge funds have been boosting their short positions against several US critical minerals companies. Their concern is that government support has pushed valuations ahead of what these businesses can realistically deliver. For the critical minerals firm US Antimony, shares on loan, which is a proxy for short selling, has risen this year from 23% of its market value to 42%. And for American Resources, they rose from 9% to 23%. Those figures suggest creeping investor doubt over whether the US's broader strategy will succeed. Even if Washington supplies the capital, the loans, the customers, and the price support, China still dominates the production, the processing, and the benchmark price assessments that determine whether or not those US projects ultimately survive. And if that remains the case, then just how much public money will the US need to build an alternative supply chain? But before we answer that question, we first need to understand the size of the physical gap that Washington is attempting to close. Rare earths are a group of 17 elements that are vital for various modern applications. This video focuses on permanent magnets, which account for around 95% of rare earth consumption. Demand for the four main magnet rare earths, neodymium, praseodymium, dysprosium, and terbium, has doubled since 2015. In the US, demand for high-performance rare earth magnets in 2025 was around 48,000 tons, but domestic supply was only around 300 tons. US firms are expected to have around 5,000 tons of capacity by the end of this year, which would still be only around 10% of demand in 2025. And that figure measures only capacity. The actual supply depends on plants being commissioned and their magnets being approved by customers. But producing magnets is just one of several challenges the US now faces. Rare earth mining only produces a concentrate of minerals. The mixture must still go to a chemical processing plant to separate it into purified oxides, which are then converted into metals, alloys, and powders. Only then can manufacturers produce finished magnets. Each stage requires different equipment expertise and quality controls. So even if a country can mine rare earths, it can still be dependent on other countries for processing and manufacturing. Washington is trying to construct the entire industrial chain at commercial scale, from mined ore all the way to finished magnets. But China already operates that complete system, and its dominance becomes even more extreme as the production shifts further downstream. In 2024, China mined 60% of the world's magnet rare earths. By the refining stage, that share rose to 91%, and then 94% in the production of sintered permanent magnets, which are the high-performance magnets used in motors, vehicles, and defense systems. That jump across the industrial chain, from 60% to 91% to 94%, is why China's system is so dominant. At the mining stage, the rest of the world still supplies a respectable 40%, but by the finished magnet stage, that share falls to just 6%. China's massive industrial ecosystem connects refiners with equipment manufacturers, chemical suppliers, skilled workers, and enormous downstream industries, including vehicles, electronics, and machinery. That not only provides scale, but also regular orders and operating expertise. There are very few suppliers of critical separation and magnet-making equipment outside of China. So, to create a rival system, the US not only needs mines and factories, but also specialist machinery and industry expertise. And because China handles most of the world's rare earth material, it has the largest number of transactions between producers, traders, and buyers. Those transactions feed price assessments used in contracts all around the world, including the one used in Washington's price protection arrangement with MP Materials. Simply put, it is China's physical market pricing that the rest of the world takes on. New projects outside China then face a circular financing problem. A developer will need funding to build a plant. Investors want long-term customer contracts before funding a plant, while customers want proof that the plant can deliver qualified output at scale before signing any contract. And while Chinese incumbents already have operating plants, qualified products, established buyers, and a live market price, rival projects must assemble all four at once. So China's power extends beyond its hefty share of raw material deposits and into processing, manufacturing, a massive customer base, and pricing. That gives China leverage at both ends of the market. When Chinese supply is plentiful and prices are weak, new competitors can struggle to cover their costs and raise finance. But when exports tighten, buyers outside China face shortages, higher prices, and factory disruption. Those issues came to light in April 2025 when Beijing placed export restrictions on 7 rare earth elements, as well as specified products containing those elements. Not surprisingly, China's magnet exports fell by around half between March and April, and then by another 53% in May, to leave shipments 74% lower than a year earlier. Licenses were eventually granted and export volumes recovered. Beijing's much wider controls announced in October were also suspended for a year. But seeing as China produces 94% of sintered permanent magnets, its export licensing system gives Beijing significant power to delay access to material that the world needs. In May, a rare earth shortage compelled Ford to stop production at its Chicago plant for a week. Suzuki also suspended production at its Japanese plants, as did several component facilities across Europe. So just a small magnet shortage was able to stop entire vehicles from being completed, and shows how an export license in Beijing can impact workers, suppliers, and customers thousands of miles away. The export controls also split regional downstream prices. The International Energy Agency found that European prices for selected controlled materials had reached up to 6 times the levels inside China. Restricted access had transferred the cost downstream to manufacturers, meaning that foreign buyers paid a premium for material that had become harder to obtain. But export controls represent just one side of China's leverage. When Chinese material is abundant and prices weaken, China's domestic producers can spread costs across its integrated supply chain, its shared infrastructure, and its vast customer base. In contrast, rival projects outside China are generally smaller and more expensive to build and operate, so weaker prices can hit them much harder. When the Pentagon unveiled its MP materials deal in July 2025, the Chinese NdPr benchmark price was around $63 per kg. But the US price floor agreed with MP was $110. So that sizable $47 gap reflects the protection against the lower Chinese price that Washington is providing MP. Without that protection, falling Chinese prices would lower the expected revenue and profitability of US projects in the face of high and persistent fixed costs. Lenders would then hesitate, causing delays in construction, and ultimately, a smaller rival would be prevented from achieving China's scale. The deal gives MP protection against nearly every major risk that might otherwise have prevented such a project from securing funding. On the capital side, the Pentagon invested $400 million in MP through convertible preferred shares. It also received a warrant to buy more common stock and provided a $150 million loan. On pricing, the $110 guaranteed floor lasts for 10 years and covers outside sales, transfers into MP's magnet business, and qualifying material placed into stock. As for guaranteeing demand, the Pentagon has also committed to buying the output of MP's planned magnet facility, called 10X, for 10 years if commercial demand falls short. And to mitigate profit risk, once 10X reaches full production, the Pentagon guarantees at least $140 million of annual EBITDA, with the floor rising by 2% each year. In plain English, that is a government-backed minimum level of operating profit. In other words, Washington is acting as a shareholder, a lender, a price insurer, a customer, and a profit guarantor for MP. The agreement also enables banks to confidently lend against a guaranteed price, customer, and profit floor, instead of relying entirely on volatile commodity prices and unproven demand. And when we look at MP's accounts, much of that support is already evident. For Q4 of last year, MP recognized $51 million of price protection income alongside $52.7 million of revenue. And in Q1 of 2026, it recognized another $42.3 million of price protection income alongside $90.6 million of revenue. So even though MP's sales are clearly growing, that $110 floor is still doing much of the work to generate income. Nonetheless, Washington can still receive considerable returns from the deal on the upside. After 10X reaches full output, MP must pass 30% of any NdPr price above $110 back to the government. Washington additionally holds equity-linked securities and receives a share of 10X's profits. It should also be highlighted that MP is committing its own cash, and it still carries construction and operating risk. It is still possible that MP encounters delays, cost overruns, and technical failures, but the bargain is clear. Washington is absorbing much of the financing, price, demand, and profit risk that's needed to make the project investable. And in return, it receives priority supply, equity exposure, and a share of MP's profits. This model could become a template for the US's broader critical minerals strategy for competing against China. But to achieve a viable alternative market, the US needs more than just new mines and factories. It needs sufficient capital, committed buyers, stored inventory, a defensible price, and enough material moving through the system at any given time. Washington is now attempting to build each of those functions. In terms of capital, the 2025 budget law authorized up to $100 billion of Pentagon lending capacity for critical mineral industries, although that is capacity rather than cash already spent. In November, the Pentagon announced $700 million of loan commitment to two rare earth magnet companies, Vulcan Elements and Re-Element Technologies. It would also receive warrants in both companies. The loans remain conditional on both companies completing financial, legal, and technical due diligence. But again, the loan and equity pattern used with NP material is being repeated here. Next comes demand and inventory. The US government's Project Vault combines a state export-import bank loan of up to $10 billion with nearly $2 billion of private capital to create a strategic reserve for US manufacturers. That reserve could prove to be a crucial buffer for offsetting temporary supply disruptions. Participating manufacturers largely determine which minerals the project buys for the reserve, and importantly, from where. Although sourcing from the US and allied nations is prioritized, there is no binding rule which confines its purchases to specific locations. That does not necessarily mean that Chinese material will dominate the stockpile, but Project Vault's reserves could end up being short of the domestic sourcing that's needed to make Washington's rival supply chain sustainable. Then comes price. Along with like-minded countries, the US Trade Representative is developing a common border-adjusted price floor for critical minerals. Suppose the protected price was $100 and an imported mineral arrived at $70. A border charge would close that $30 gap to lift the landed price to the $100 price floor. This policy would defend higher-cost domestic supply from cheaper imports, and it would raise costs for manufacturers inside that protected market. The agreement also shows that Washington's price ambition has moved beyond guaranteeing just one company and towards creating an allied trading zone with a minimum protected price. Now put all these measures together. The state is supplying capital, pooling demand, financing inventories, and constructing a protected price. In other words, the US is attempting to create a parallel market. But it is not yet a functioning alternative to China's system. The loans granted remain conditional. Project Vault's reserve sourcing is ambiguous. The Allied price agreement is unfinished. And still no liquid pricing benchmark outside of China exists. And it's that gap between policy architecture and commercial execution where Wall Street remains skeptical. Public support is undoubtedly making the financing of these projects more viable, but investors must still decide whether plants will be built on time, produce qualified material, attract long-lasting customers, and eventually operate without expanding support. And although billions have already been invested in several government-backed US critical minerals companies, hedge funds are betting that Washington's support has pushed some valuations ahead of what those companies can realistically deliver. That's partly because Washington is measuring success differently to common shareholders. For the government, a project can be valuable because it prevents a military supply interruption, even if its financial return is modest. Whereas a shareholder buys at the current market price and needs future cash flow to justify that price after delays, cost overruns, new share issuance, and any upside returned to Washington. So although government support can improve a project's chance of survival, it does not guarantee an attractive return on its equity. In the case of US antimony, shares nearly tripled during 2025 after it secured a 5-year Pentagon contract worth up to $245 million. By Q1 of this year, the company had received around $12 million of orders, but it had not recognized any revenue that was directly attributable to those orders. As it stands, short sellers are betting that delivery of materials to the Pentagon will take longer or prove more expensive than the company's valuation already assumes. As for the mining company USA Rare Earth, it received a proposed federal package including $277 million of funding and up to $1.3 billion of loan capacity in return for shares and warrants. The package also raised $1.5 billion in private capital through 70 million new shares being issued. That capital supports the company's construction of mining and processing plants, as well as magnet facilities. It also spreads the company's future value across many more claims. But while such support makes the project more likely to succeed, the eventual return for a shareholder remains uncertain. What these examples show is that government backing does not automatically make these shares good investments. There are clear gaps that separate the interests of investors from the interests of Washington. Firstly, government commitments only turn into revenue after orders are received, material is delivered, and sales are recorded. Second, the capital raised only becomes industrial capability after facilities operate reliably and customers approve their output. And third, while a project might be valuable to Washington because it secures military supplies, shareholders need sufficient profits after accounting for delays, cost overruns, dilution, and government claims on the upside. So although Washington is buying supply security, Wall Street continues to judge the equity returns. And if commercial returns cannot pay for that security, the additional cost of building a secure alternative mineral supply chain must move onto other balance sheets. Washington can spread that cost across the federal government, critical minerals companies, manufacturers, and investors. Price guarantees create federal exposure. Failed projects hit companies. New shares dilute investors. And border price floors raise manufacturers' costs, some of which may eventually reach buyers. If the proposed floor covers the NdPr rare earth price, but excludes finished magnets and motors, for example, US producers will inherit the higher protected input price, but foreign producers can still use cheaper Chinese material and export the finished component. That loophole creates pressure to extend the price protection further downstream. So the government can influence where the costs of building an alternative supply chain most prominently show up, but it cannot make those costs disappear. Ultimately, Washington must weigh those costs up against the cost of a stopped factory, or a delayed weapons program, or an essential component being unavailable during a crisis. The strongest case for paying that premium begins with the enormous economic value that crucially hinges on critical minerals. The IEA estimates that building enough rare earth supply to meet demand outside of China would require around $60 billion of cumulative investment over the next decade. It also estimates that full implementation of China's rare earth export controls could place at risk a potential $6.5 trillion of annual downstream production outside of China. Much would depend on how long China's restrictions remained in place, as well as available inventories and how quickly manufacturers could adapt. The automotive factory stoppages already demonstrated that mechanism, with a small magnet shortage proving sufficient for halting vehicle and component production. Once an assembly line stops, the effects spread into production shifts, supplier orders, and vehicle deliveries. The IEA also estimates that even if rare earth prices were to triple, it would only add 0.1% to the cost of a car. Magnet and motor producers may still face significant margin pressure, but at the final vehicle stage, the security premium could pale in comparison with the cost of losing access to the component altogether. So that is the logic behind paying more for diversified supply. Washington is buying redundant capacity, emergency inventory, technical knowledge, and the option to keep critical production running during a disruption, such as a Chinese export bottleneck. But that spending earns its justification only through completed facilities, qualified output, diversified sourcing, and usable inventory, and not through announcements alone. So keep an eye on 3 key indicators that will tell us whether Washington is purchasing a genuinely resilient alternative to China or merely financing the promise of it. The first indicator is qualified output. Track the actual tons of material being produced and shipped, not simply the announcement of future capacity. Rising utilization and repeat customer orders would show that public funding is turning into industrial progress, whereas repeated delays and large gaps between stated capacity and actual output would indicate failure. The second indicator is pricing independence. Track the difference between Asian Metal's Chinese NdPr price and MP's $110 floor. A wider price gap means the Pentagon is absorbing more financial costs to support US production's competitive position against China. Then watch for the emergence of a credible, non-Chinese pricing benchmark with sufficient liquidity through repeated physical transactions. If the alternative market can finally use its own reference price, that could eventually trigger a significant transfer of power in Washington's favor. And the third indicator is whether Washington continues to depend on Chinese-linked supply. From the start of 2027, the Pentagon's restrictions on rare earth magnets extend right across the entire supply chain, from mining the inputs through to the finished magnet. But the rules allow for exceptions when compliant material cannot be procured at a reasonable price. And so frequently granted exceptions would show that physical supply continues to lag behind demand. Project Vault's critical minerals reserve for American manufacturers provides another crucial test. Track where Vault buys its inventory and where further processing occurs if needed. Chinese processed material could cushion a temporary disruption, but repeated purchases from China would not create dependable demand for US and allied suppliers. And stockpiled material offers even less protection if it must still be sent to China for processing. Together, these three indicators separate the headline scale of Washington's commitments from an actual shift in industrial power. But the decisive evidence will be whether or not US and allied supply chain can keep factories and defense contractors operating when access to Chinese material tightens. And it's that $110 price floor that captures the entire problem. Although it's Washington that chooses the guaranteed price, it is still China's physical market that determines just how much public money is required to maintain that price. Once qualified output reaches commercial scale, once the Pentagon stops needing to issue restriction waivers on Chinese-linked supply, and once a credible non-China pricing benchmark emerges, the US will gain genuine room to maneuver. For now, Washington can guarantee a price floor, but it's China that determines just how much that guarantee will cost. If you found this analysis useful, consider hitting the like button and subscribing to the channel. Here at Markets and Power, we examine how states, institutions, and corporations exercise power, and how markets, capital flows, and economic outcomes reveal the consequences of those choices. Thanks for watching, and I'll see you in the next video.